Welcome again to a look at gold market fundamentals with David Jensen. Welcome, David. Good to talk to you again.
Good morning, Jay. Nice to talk to you again.
And we want to start out this week by talking about the World Gold Council. The World Gold Council has been around for quite a few years. It is looked at by the mainstream as the prestigious purveyor of information about gold, but some people seem to think that it might be more misinformation than information. Talk to us a little bit about the World Gold Council, its origins, and what it's up to.
Yeah, I think it's valuable to look at the World Gold Council in terms of its pedigree of where it came from, and then look forward to today in terms of what it's doing. But the World Gold Council was formed in 1987, and a friend of both yours and mine, Larry Parks, notes that it was formed with a $25 million founding grant from Harry Oppenheimer, who is also the chairman of Anglo-American Gold. Harry is an interesting fellow, because of his background with De Beers as well. But he had a view of gold which was really that he was an anti-gold money advocate. In his comment there, you can see it in The Economist, which I'll put in a link in the show notes. He said the people bought gold because they were, quote, too stupid to think of any other monetary system that will work.
Huh.
And so it's interesting that Harry provided the founding grant, which was a lot of money in 1987, to get it going. And it's got an annual budget of around $70 million now, which it obtains from the gold mining industry. And the research budget that the World Gold Council uses is about $30 million. And it continually comes up with what I really consider disinformative information. It guides people incorrectly in terms of the true state of demand for gold. I think that really the clearest example of that is their analysis of the Chinese gold demand. Jensen, who posts now at Bullion Star out of Singapore. But, I mean, he's had next to no research budget, and he's gone through the Shanghai supply-demand fundamentals from the Shanghai Gold Exchange. And he's come up with the last 2 years have seen 2,000 tons, more than 2,000 tons each of the last 2 years being withdrawn from that exchange alone. And that's kilobars that are each are uniquely numbered with a laser etched serial number, and they cannot be returned to the exchange. So these are used as really a proxy for the demand for gold in China. And so they've been over 2,000 tons per year the last 2 years. And yet the World Gold Council shows, for instance, this year that in 2014, that the Chinese demand was about 800 tons.
Wow.
So we have hard information from the Shanghai Gold Exchange, and then we have the World Gold Council showing Chinese demand at about 40% of what we know is a physical pull from one of the exchanges. And by the way, that these numbers don't include Chinese government delivery of gold, which is believed to go directly to Beijing and not come through these exchanges.
Wow.
So we look at this split between what we know is global demand and then what the World Gold Council tells us is demand. And the World Gold Council's view really fits well with what the paper price decline has been. And it really is used as something that I see as supporting the LBMA's endless virtual cycle of trading non-existent metal.
Mm-hmm. One wonders, what the World Gold Council is doing with that $70 million budget. If they're, we see ads from time to time about beautiful girls with jewelry, wearing jewelry. We know they put on different events and so forth. But and the other thing I know that Larry and I have talked about in the past is Larry has pointed out that basically with respect to jewelry, there's an inverse relationship. Jewelers, of course, quite understandably want to see the price of gold go down, or at least the manufacturers do, because that's their cost of goods. Mm-hmm. So the more jewelry that's sold, the lower the gold price. Interestingly enough.
Well, they promote the use of jewelry, and it really distracts investors in terms of the monetary aspect and the investment aspect of gold.
Right. Right.
We see 200 million ounces of gold per day trading in London. I mean, that's a number which should shock everybody, given, around 100 million ounces a year of mine production, plus or minus. And that's with an above-ground stock of 5.5 billion ounces. And yet, the World Gold Council doesn't really focus on that, enormous demand, notional demand for spot trading of gold in London. And it gives poor statistical, it's really silly statistical analysis of the Chinese market demand. So there's serious problems here, and I think that the nub of all this is that the mining companies are paying money from their shareholders to support the World Gold Council, which is really destructive to the interests of the gold miners themselves.
Mm-hmm.
And secondly, that the miners are pricing their gold on the LBMA, which is a paper pricing market, a virtual market, which really does not reflect true trading of gold as you would have on the Shanghai Gold Exchange. And so they're using a virtual gold market, a paper gold market, which dilutes the value of real gold. And so the mining industry is supporting these two organizations, which is really destructive to the mining industry as a whole.
Mm-hmm. Definitely undercutting the mining industry, it seems to me.
Yeah, so things are not going to improve until these practices stop and people wake up to the fact that they are really being distracted by these two institutions, the LBMA and the World Gold Council, and that they appear to work hand in hand in terms of providing a artificial sense of the gold world. The investment value of gold, the monetary aspect of gold, which is the most important, as even Alan Greenspan says, that gold is a premier currency, or I'd say really it's gold is money.
Mm-hmm.
But that is totally ignored in this distraction of questionable statistical analysis and questionable trading in London is really what predominates in terms of the business world.
Yeah. Well, but you go back to Harry Oppenheimer again, and, his quote that people who bought gold because they're too stupid to think of any other monetary system that will work kind of says it all and provides, I guess, the philosophical basis for the World Gold Council actually trying to distort the real value of gold, which is in its monetary value, not in its value as jewelry. And one of the things that I remember Larry Parks, at least this is going back several years, talked about was that there was something at that time like 55 years of above ground gold supply. I guess if you were to use gold in industry or whatever, it would take 55 years, and of course that would, assuming no new gold is being mined. And then you'd have 5, 6, 7 years maybe, or a few years of silver at that time, and copper, on the other hand, with a couple of months. So gold derives its value as a monetary unit that sits in a vault, basically, or would be used in trade if it were allowed to do so. So that the fact that the World Gold Council is actually trying to sell gold as jewelry, as you say, it just causes people not to think of gold as money. But then one would think that was probably Harry Oppenheimer's intent.
Yeah, what we can say is that the pedigree of the World Gold Council is one that was financed by Henry Oppenheimer, who was anti-gold, and that since that time that the World Gold Council appears to have been providing information which is, in my view, is a distraction and somewhat, I believe, misleading. And it shouldn't be surprising, perhaps, that a person who is that anti-gold in terms of gold as a monetary asset, who financed this institution, that this institution should provide this kind of information.
Well, probably it helps to explain also this kind of propaganda from the World Gold Council, why gold is leaving the West and heading for China and elsewhere. But, David, another topic that you brought to my attention recently, and I want to thank you very much for it because I think we're going to make some money on this one, palladium. We call this show a look at gold fundamentals, but really palladium as a precious metal is in a way related to gold. And you're noticing some reasons that you've turned very bullish on palladium. Explain why you like this metal so much right now.
Yeah, we go back to the late 90s, and there was a deficit. maybe to start is that Sharps Pixley of London is looking at about a 1.4 million ounce, call it 1.5 million ounce deficit this year of supply of palladium to the market. And this is into an 8 million ounce per annum total market. In the late 90s, we had a similar situation of deficit of roughly a 2 million ounce deficit in the market. And it created a crisis in London on the LPPM, the London Platinum and Palladium market, in that the shortage, the banks that were short at that time were really in crisis. And the reason was that they were unable to deliver physical metal to their positions, which were being called for delivery. And the situation got so out of hand that they were, and this comes from a Ted Butler article at that point in time. He was noting that the lease rate for physical palladium was running about 300% on the 1 month basis. So they were paying 25% per month.
That's incredible. That's absolutely that's usurious and then some.
Well, it's a reflection of horrific shortage caused in a paper market.
Sure.
And so what's interesting is that these leases, many of them are paid in metal, and so it was really an exponentially growing problem that was happening at that point. Now, what happened then was that the Russians, who had these massive stockpiles, it was estimated between 20 and 30 million ounces that they held in these stockpiles, stepped in and supplied the market and have supplied the market ever since. But what has now happened, what we find now, is that the Russian stockpiles are gone. And Russia has, since the late 90s, has really allowed a situation in which there's a structural deficit to be met with a temporary plug of their physical metal into the market. And their physical metal is now gone in terms of the stockpiles. And not only is their physical metal gone, but they, as a company which represents 40% of global mine supply, with South Africa producing a similar amount, Russia has now announced that their state metals agency, Gokran, would be looking to enter the market this year as a buyer.
Wow.
So we have a swing, of roughly 1.5 million ounces per year over the last decade plus of being provided into the market is gone, and now not only that 1.5 million ounce plug is not available, but there's going to be further buying by Russia to reestablish these stockpiles. So we have this situation now where we're right back to the 1990 situation where there are these enormous deficits in an 8 million ounce market. You've got 1.5 million ounces in it. HSBC, we'll touch on them later, but they have put out a piece projecting forward 1.5 million ounce per year deficit of supply as well going forward for the next several years. So the situation's not going away. The metal is gone, and I don't know how these paper. You and I talked about this last year, in terms of the mining strike in South Africa impacting the market, and there was a very large deficit last year of over 1.5 million ounces, and now we're going to have it again this year and going forward. So this is going to be very interesting to see, and the palladium market may be one of the first paper markets which goes sideways. Paper setting of prices only works as long as there's physical flow in the background, and it looks like the physical flow is about to disappear or be heavily impacted by these shortages.
Right, palladium being probably the tightest of supply in those among the precious metals, and probably platinum next, and then silver, and then lastly gold, because as I just noted, there's many years of above ground gold supply, but when you get to palladium, we're actually going to be running a deficit the way it looks. And
that's right.
Yeah. Well, I can't help but think also, David, the connection with geopolitics here. That palladium became available after the fall of the Soviet Union. And now, of course, we're going back, it seems, into a new Cold War in which Russia is more closely aligned now with China once again, and looking to trade with China out of necessity. I would argue that we're sort of forcing their hand in that regard. but it just all seems to be coming together, and the Western world may be rather desperate to try to find supplies to meet their own industrial demands, and so I think we're looking at different ways that we may be able to profit. The markets will certainly try to adjust by finding new supplies, and I would guess that some mining companies might be beneficiaries. Shareholders of mining companies might do quite well.
Yeah, the price. If we look at the price in currencies other than the U.S. dollar, as you and I touched on just before the show started here, the U.S. dollar index has appreciated. The dollar has become 25% stronger versus all other currencies. Has risen 25% in its buying power versus the other major currencies since last summer.
Yeah, incredible move.
Yeah, and so even given that, a Commerce Bank put out a prediction that that Palladium was at a breakout point now, a multi-year breakout point, and set to really run in U.S. dollar terms. But if we look at it in euro terms, we can see that it has already just shot through the roof. It's gone to much higher levels in the last few months, priced in euros. And that is one of the primary markets for this, where it was used as an auto catalyst to in the catalytic converters to remove pollution. So these demands continue going forward in Europe and in China, and the price is rising in the major currencies, except for the U.S. dollar. And even in the U.S. dollar, we're seeing it at the breakout point in terms of going much higher. So I would say keep your eye on the physical market. And see what happens there.
David, do you think at some point palladium rises in price to match platinum? Would catalytic converters start using platinum then again?
That is one of the things that platinum has been retained for use in diesel engines, because it's the only catalyst that works in those catalytic converters. Mm-hmm. But the auto industry had switched to palladium because of the high cost of platinum. So the potential is there, although the cost of platinum is in round numbers about 50% higher than it is in palladium.
Yeah.
So the potential is there, but the platinum market is also in deficit, with 90% of platinum coming from South Africa in terms of annual mine production. So these two metals are really intriguing, pardon me, in terms of their strategic significance and their sources of supply. And with the geopolitical world, if we look at the BRICS, Brazil, Russia, India, and China, and South Africa. And South Africa and Russia are both part of the BRICS nations. So if we do see a switch over to gold-backed currency by the BRICS nations, importing platinum and palladium from these countries is going to be a bit of a tough go.
No question about it. Well, at least I think that's one of the markets I think we want to watch very closely for the reasons you just outlined. The third topic that we'd like to talk about today has to do with HSBC, and they are very rapidly shutting down their 7 different London vaults, gold vaults, I guess. Kind of not too much in the news about it, but it's happening, and it's happening very rapidly. Talk to us about that and why that might be important to keep an eye on.
Yeah, it's Ned Naylor-Leland has been climbing all over this one, and interestingly enough, he was also the analyst who picked up on the GLD ETF fiasco of a couple of years ago at HSBC's vaults, where Bob Pisani of CNBC was led around London with a blindfold on and went into the vaults and picked up a bar from the GLD gold holdings, and then Ned picks up the serial number of the bar and realizes that bar doesn't belong to GLD at all.
Wow.
And so, Ned, again, is picked up here on something from HSBC that a metal broker had noted to him that they had received notice from HSBC that they're closing their vaulting facilities. And this is something that's, I think the reason that it's really notable is that these 7 vaults in the UK, which are used to store valuables, and I would presume primarily precious metals, but that they're being shut down with very sudden notice of 60 days, and it's shut. And the notice that they've given, there's been no public announcement by HSBC, and both Ned and Ned Naylor Leyland and Alistair MacLeod, who's also following this topic, have noted there's been no statement by HSBC on these GLD ETF holdings, the exchange traded funds where you can buy and sell these GLD stocks or equities, which are notionally backed by gold, and HSBC has given no announcement as to if there's going to be any impact on GLD. So this all ties together. GLD has been very useful for moving retail money into what many say is just paper gold.
Sure.
Because of all their prospectus for GLD have all these riders on them in terms of their sub-custodians who hold the metal, that they can't guarantee that they actually have the metal. There's been a lot of questions raised. So we'll see where this goes, but it's, the 60-day notice and the way that it was done in a very quiet way with no public announcement by HSBC, and now a delayed announcement in terms of the impact on GLD, it certainly points in an interesting direction, and it's not, I think, what you'd like to see from a major bank to which people entrust their savings and their valuables, such as HSBC.
Certainly, the GLD and other ETFs have taken the place for retail investors. I think keeping them out of the gold mining shares, perhaps. It's Dennis Gartman going on CNBC talking about, well, don't be bothered buying the gold mining shares. You can just buy just as good and even better buy GLD. And of course, this is what you and I have been talking about, the paper gold markets. The massive amounts of volume that has come into the spot markets and the futures markets at the LBMA and elsewhere, that basically people actually think they own gold, but in fact there's not nearly enough gold to go around for all the game of musical chairs, so to speak. So when the music stops, one of these days, David, there's going to be some big surprises out there, I guess, and that's what we're looking to try to be aware of, so that we're ready to put our fannies down in that chair when the music stops.
Or be in it already.
Exactly right. Exactly right.
I think that HSBC, with their on the Palladium front, with their announcement of their projections of a continued 1.5 million ounce deficit, and that's using current supply demand analyses, without further demand coming from the investment side. But the paper game trading of setting the price of metals by trading not the metal themselves, but paper or virtual instruments called metal, that may be coming to a close here. And if that is indeed the case, Jay, and if there has been any less than acceptable activity going on at the GLD in terms of selling paper and not really holding the gold, not having the physical metal allocated and set aside, they will have to close down this GLD before there's a sudden movement in metal and before there's a panic in the physical market, because otherwise GLD shareholders will show up and they will say, okay, we'll take delivery of the metal, and that's when you don't want GLD to be in operation. You would like it to be shut down and people, the problem handed off somewhere else, because that will immediately advertise that what has gone on has been a paper distraction, as some suspect that it has been with the GLD.
Yeah, some suspect that, going way back. I remember James Turk, of course, talking perhaps from his own vested interest, and was open about that with gold money. Talked about, read the prospectus, what they're telling you, and there's a lot of, as you noted, there's a lot of outs. They don't have to really deliver the gold. They can deliver fiat in its place. Well, David, I also, just before we conclude our discussion today, we talked in the past about what was going on in Shanghai. That is a physical market, as I understand, that we talked about. Any update on that? Is that close to fruition now? Is that in actually taking place now?
Well, the Shanghai Gold Exchange is in operation, and the international board in the free trade zone is in operation as well. what people have been talking about recently is a yuan daily fix in gold.
Oh, okay.
And so that appears to be in the works, and that would be, I think, necessary if you're going to be switching over to China as a global gold price setting mechanism. And I would expect that daily fix in yuan to happen when there's a handover of gold pricing from London to China. So answering your question, there seems to be an expectation that it's near happening now, either in the coming months or in the very near future. But I think that maybe relating back to the World Gold Council and Shanghai and London is that all of this distraction and distortion in the price and awareness of what's going on in the gold market has really allowed transfer of an enormous amount of wealth from the West to China and to Asia without the public in the West being aware of it. And the World Gold Council's activities, my perception is that they are really distortive in terms of understanding what's going on, and that these World Gold Council's activities, as well as the LBMA's activities, have allowed this net transfer of Western wealth to China, and that it won't be replaceable. But it's essential that it be stopped as soon as possible because of its implications for our society for the future.
No question about it, David. No question about it. Well, it would be interesting to watch for sure, because if we can get a daily quote, a physical gold quote in yuan, and then look at the exchange rate, we can go back to what it would be in U.S. dollars or Canadian dollars or what have you, right?
Yeah, I think that the key there is that the global price is going to be set in Shanghai with real trading, and that I suspect it's going to tell a very different story than the price that is set in London with paper trading.
Let's hope that an accurate story, a real story, a truthful story is told. That's what we're asking for. That's what we're complaining about when we talk about the paper markets that are distorting the real price of gold and the other metals. Anything else today, David, before we conclude our discussion?
No, I think just that closing thought of the basic the extraction and the drain of Western wealth and Western standard of living through really a fraudulent extraction of gold from the West, really coordinated by the City of London, is really an unfortunate thing, and it needs to be stopped as soon as possible.
Thank you very much, David, for your thoughts and your insights. Look forward to doing it again real soon.
Thank you, Jay.